And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Monday as we start the second half of the month of May, getting ready to wrap up this month pretty quick. It'll just be by before you know it. Of course, over the weekend, lots of graduation parties. I had mine with my daughter, so at least that's over. Like 80 people at our house. I'm too old for this stuff anymore. I'm like, thanks for coming. Please get out now. So that's nice and over. But her graduation, of course, on Tuesday, she graduates is her actual graduation day. So lots of graduations coming up here for everybody, and I sympathize with all of you that have to go through that. So, but congratulations if you have somebody graduating. Big news over the weekend, of course, really lots of big news over the weekend. Our hearts, prayers, and sympathies go out to the Biden family. He was diagnosed with stage 4 prostate cancer over the weekend. It's already metastasized to the bone, so it's a very grim outlook at this point. And regardless of your political views or whatever else it is, there's people that have dealt with prostate cancer or have been involved with it. Certainly know, how challenging that can be. And again, our sympathies and prayers go out to the Biden family for that. Also, the other big news of the weekend that we're going to get into a lot this morning was the Moody's downgrade of U.S. debt. And again, over the weekends, lots of teeth gnashing and finger biting and the Bears having a parade day for this debt downgrade. We'll get into this morning. What does it mean? Does it mean anything? And more importantly, what does it mean to the stock and bond markets? We've had debt downgrades before, so we can look at history and see how these things work out. But we'll go through all the dynamics of how the bond market works, where funding comes from, all that stuff, and whether or not this debt downgrade means really anything at all. So we'll get into that this morning. Outside of that, though, we're pretty much wrapped up with earnings. This week we have NVIDIA. So that's the one big kind of outlier for earnings at this point to wrap up quarter one earnings. And then about as quick as you can breathe, take a nap and eat dinner, quarter two is going to start. And it's just, we're going to start reporting quarter two earnings in about another month and a half. So for right now, the buyback window's open. Buybacks are in full swing right now. The only person not buying buybacks at the moment is NVIDIA until they report, but they'll start buying back shares as well. But that window is now pretty much fully open. Buybacks helping kind of really been a big driver of this market over the course of the last couple of weeks. That support is likely to continue here for about another 2-3 weeks. Once we start getting into mid-June, that window will start to close because earnings will start again on July the 1st. And hard to believe, we're almost to July the 4th. This year's already almost halfway over, pretty fast. How quick I'm dying. So, oh, and I forgot Memorial Day this weekend. So Monday is a holiday? Yes, it is. Monday is a holiday. So we will have a long 3-day weekend this weekend, which means holiday shortened trading week next week as well. I was wondering why. I was reading this morning that one of the articles, publications I read is like, we won't be here on Monday, and I didn't know why. So now I do. So this is how far out of the loop I am on stuff right now. It's like, holiday? What holiday? So there you go. All right, let's talk a little bit about what you need to know before the bell this morning. It's going to be a little bit longer than normal. I've just got a few things I want to roll through this morning with you. So we've had this very, very strong rally from the kind of tariff liberation lows. So back on April the 6th, we had this announcement on the tariffs, and this is more onerous than expected. Market plunges. We were at 19.2% peak to trough on that decline. So right at the cusp of a 20% decline, which only happens about 13% of the time throughout history. So these types of declines do not happen very often. So they're important when they do. We need to pay attention to them. Since then, we've had a 19% rally, and we are currently about 2% off all-time high. So just right there, right? We're almost have fully recovered this entire decline in just the last 3 weeks. This was a very, very strong advance. And again, from a momentum basis, we're extremely overbought. Relative strength, we're extremely overbought. this market needs to pause. Now, this morning, futures are pointing down about 1% on the back of this event of this Moody's debt downgrade. So we're going to see pressure in the bond market this morning. We'll see pressure in the stock market. That is not surprising at all, only because things have had such a big rally that you should expect some type of reversal here. So this is, you need an event generally to bring some sellers to markets, and that's what's happening here, is that we've had a very, very strong rally, and nobody was wanting to sell because the market was just going up every single day. And it's like, well, I don't want to sell here because the market's going to go up tomorrow. Well, you need some event to break that psychology, and that's what's happening today a little bit. So again, markets will be down. I'm looking at futures, just 1 second, be down about 1% here at the open. So, we'll have a bit of a pullback here. And again, as we talked about before, what we want to see here is a pullback that holds this 200-day moving average through the end of this week. If we are going to make an advance to all-time highs, we need to kind of hold support here at this kind of 200-day moving average. So a bit of a pullback here today gets us kind of close to that 200-day moving average. We kind of flop around here for a couple of days, build some support at that moving average crossover, and then we can work our way higher. If we fail that, then we're going to come down here and start challenging the 20-day and the 50-day moving average, which the 20-day is now trading above the 50-day. So we've got good support being built here around 55.50-ish, 50 and 55.60, somewhere right around there. So again, there's decent downside here for correction, a couple hundred points, so don't dismiss that. Again, as we've talked about before, this is a really good opportunity to kind of rebalance portfolios, trim some risk, those type of things, raise a little bit of cash, because we're going to get some type of pullback here. The only question is, how big is it? Is it a mild pullback here to 57.50, or is it something that gets us down into the 5,600 range? I don't know. We'll see. But, historically, these pullbacks need to happen when you're this egregiously kind of overbought on multiple levels. Now, feeding into that, of course, is the volatility index, and we are very close to triggering a buy signal on the VIX. So we've had this so here was April 6th. You had this massive spike in volatility. You've completely reversed all that. We were down below 19 on Friday. So again, you've completely reversed all that volatility. So you're seeing a bit of a pickup today in volatility because of this Moody's debt downgrade. So you're seeing a bit of a pickup there. If we trigger a buy signal, we could see a move higher back potentially into the 20s here. That would coincide with a little bit of a bigger drawdown in the market. So again, we need to have this correction. The correction is healthy, particularly after this run. We need to work off those overbought conditions. The volatility index is telling us that we're probably getting pretty close to the point that that's going to happen. So again, whether or not today's sell-off kind of feeds into a couple of days of sell-off or 2 or 3 days of pullback, whatever it is that works off some of that condition, we'll see. But as long as we can maintain the VIX, in the low 20s, markets don't start breaking any type of major supports, this will be a sort of a corrective pullback that we need to work off those conditions, give you a little bit better entry point into the markets. Crude oil, last week we sold our crude oil positions on, I think, Thursday. Crude oil's gotten very, very kind of oversold here. We just took that risk off the table. We made some money on that on the trade in crude, so that was fine. But again, you're getting kind of close here to a potential where we could get a bit more of an advance here in oil. So oil's been trying to consolidating here a bit in this range. We had this move higher, and now we're kind of just in this flux point for oil prices. So again, just economically, we're seeing a slowdown in the markets. We're seeing a slowdown in the economy. Would expect to see that kind of reflect also back in crude oil prices. So again, that's one of the reasons that we kind of took our oil energy positions off the table. So overall, again, nothing more than just simply a corrective pullback here, but watch the VIX here over the next day or so as we kind of process this Moody's downgrade, this headline, because as we'll get into this morning, I'll show you kind of the history of what's happened with markets, both stocks and bonds, on previous downgrades. We'll get into that when we come back from the show. But that's what you need to know before the bell this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How confident are you in your retirement income strategy? Join RIA for a powerful in-person workshop designed to help you build a sustainable, tax-efficient income plan for retirement. Richard Rosso and Danny Ratliff host the RIA Retirement Income Empowerment Workshop, Saturday, June 14th at the Hyatt Centric in the Woodlands. Learn how to protect your nest egg, optimize Social Security, reduce taxes, and create income that lasts. Register now for the RIA Retirement Income Empowerment Workshop with Ratliff and Rosso at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So it's Monday. My chart wasn't working this morning. It's always something on a Monday, right? Moody's debt downgrade. Tons of headlines running out over the weekend. I got so many emails over the weekend. Please, on Sunday, just hang on to them till Monday, okay? Just give me a small break. I answer them all. I answer every email when it comes in. So got them all answered. But, there's so much concern. Videos are coming out, headlines, Moody's debt downgrade. There are things that people are talking about, well, it just means we can't repay our debt, those type of things. And look, none of those headlines have any validity to them. Because the people making these headlines don't understand how the Treasury bond market works. So we're going to go through some of the plumbing today so you can have a better understanding about how the Treasury bond market works, why the debt downgrade doesn't matter, and how stock and bond markets have responded to previous downgrades, because this isn't the first one, right? So we'll go through the whole history this morning with you. So stick around. It's going to take we're going to have to burn a couple of segments this morning to get through all this, because it's a lot of work. But you've probably read dozens of pieces over the weekends about the dire consequences of the U.S. Treasury market, and the first thing you have to understand is that the Moody's downgraded the U.S. debt, right? So their statement was this: successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs. This has been something that has really grabbed the media attention as of late. We've had a lot of people talking about it over the last, 4, 5, 6 months. Nobody seemed to worry about this that much when, we had a $4 trillion deficit under the Biden administration when we were doing the Inflation Reduction Act and the CHIPS Act and all. Nobody seemed to mind $4 trillion at that point. But now that we're down to $2 trillion, now the debt is a problem, right? It's because interest rates have come up. I get it. The mainstream take here is that the U.S. will never be able to repay its debt and interest because the costs have now exceeded $1 trillion a year. That's the concern. However, once you understand the monetary system, both those assertions don't make any sense. So I've got this chart for you. Not this one. Hold on, Brent. I need this one. I need this chart, which is how the economy prints money. And so the government, the Fed, the banks, households, this is basically the balance sheet of how it works. What you have to remember is that when the government issues, so we have a deficit. What is a deficit? A deficit is simply the fact that the government has spent more money than it has taken in revenue, just like most households today. They bring in so much revenue, but their cost of living exceeds their income, so they go into credit card debt. It's the same idea, right? Very different structure, mind you, but it's the same idea. We just have spent more than we've taken in revenue. Now, unlike a household, governments can print more money. Households can't. Well, you could, but it's called counterfeiting, and you go to jail for that. But governments can print money as long as they are a sovereign issuer, right? So one of the problems that the Eurozone has gotten itself into is this whole Eurozone monetary system where these countries gave up their ability, Germany gave up their ability to print the Deutschmark. So they don't have their ability to print their own currency. The U.S. does. Now, I'm not arguing that that's a good thing, right? I'm just telling you the way the function works, because this balance sheet is very important. Because now this is what you have to think about. Where does the money go? Right? So the government is spending money. They're spending more money than they're bringing in revenue. Where's all that spending going? Is it just going off into the ether sphere somewhere, just magically disappearing out of the world? Or is it getting spent on things that wind up into the U.S. economy? Now think about that for a moment. Where does the money go? It's got to go somewhere. It winds up on the balance sheets of households and corporations. U.S. government says, okay, we're going to spend $1 billion repairing a road or a bridge or whatever it is. Well, you have to hire workers. You've got to hire construction crews. You've got to buy the materials. All that winds up on the balance sheets of the workers, the corporations that supply the products, the people that do, organize all the transportation, all that stuff, right? They're all receiving money from the government. Social Security, Medicaid, welfare, all winds up in the household balance sheet. Now, this is crucial to understand, because it's a transfer of assets from the government to the U.S. household. Where does the household put the money? Winds up in the bank. What does the bank do with the money? It increases their reserves. What do they need in order to do their lending? They need collateral, treasury collateral. They buy more bonds. So this idea of the money is that it's a big circular function within the government and the country. Because what winds up on the balance sheet of the household is the expense that came off of the government. So, again, I'm not arguing this is a good thing or a bad thing. I'm just telling you how it works. When you downgrade the debt, it changes nothing for that operational system. And by the way, the downgrade, just so you understand, they lowered it one tick. So it went from AAA to AA plus. That's it. Just so you're in line with the debt downgrade. Now, the issue is that any government doing deficit spending, issuing bonds in its own currency, and this is important.
right? It has to be in its own currency. If they're doing that, they're not walking into the abyss of doom. It's just choosing to stimulate the economy by putting money into the private sector. If you reverse this process, now, I've been getting a lot of emails like, we're destined for a massive depression. If you want a really, really deep recession, stop printing money, right? Stop issuing debt, stop doing deficit spending, reverse all that, go into a government surplus, and you will have a very, very deep recession because you're going to extract a massive amount of capital out of the U.S. economy. So be careful what you wish for. The process of all this, right, is very important to understand. But here's what's even more important about this, is that the downgrade doesn't affect the risk-free basis or the value of the reserve currency. It doesn't change that dynamic at all. The banks need to buy the bonds. The primary dealers buy the bonds so when the government comes to auction, they say, okay, we're going to auction debt. Doesn't change anything. It is still the premier gold standard risk-free asset in the world because there's no other alternative. The rating changes nothing about that. Pension funds, institutions, foreign holders of bonds, they buy treasuries. In fact, that brings up something real quick, just while I'm on this. I just posted this out on X this morning. Brent, give me just 1 second to find this. Lots of conversations as of late about how the foreigner, I got two charts here, Brent, coming up. So this one and one more after this one. Lots of conversations about foreigners are dumping U.S. debt. They don't want it anymore. And I've been telling you that's not true at all. In fact, foreign purchase of U.S. Treasury bonds and notes are some of the highest levels on record right now, as of the latest report. Brent, I'm going to change charts. Foreign holdings of U.S. Treasuries by Japan and the UK rising. China has been declining a little bit, but there's not record dumping of this. This is all about currency valuation, just balancing currency reserves. And most of this has just been a transfer of buying long-dated treasuries for shorter-dated treasuries because they get a better yield. So all this headlines that you've been reading are wrong. But we're going to come back and look at the previous debt downgrades and how the stock and bond markets reacted to it so that you can get a better handle on probably what happens next. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
How confident are you in your retirement income strategy? Join RIA for a powerful in-person workshop designed to help you build a sustainable, tax-efficient income plan for retirement. Richard Rosso and Danny Ratliff host the RIA Retirement Income Empowerment Workshop, Saturday, June 14th at the Hyatt Centric in the Woodlands. Learn how to protect your nest egg, optimize minimize Social Security, reduce taxes, and create income that lasts. Register now for the RIA Retirement Income Empowerment Workshop with Ratliff and Rosso at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So there's a whole big food discussion going on in our chat channel right now. Brent just weighed in saying can't beat a hot chocolate chip cookie from Chick-fil-A.
The Real Investment Show podcast.
I disagree, because at Slotsky's not only can you get a chocolate chip cookie, you can also get a hot cinnamon roll.
That's like apples and oranges.
That is not apples and oranges.
It's cookies and bun.
But you could take a Cinnabon and put it between two chocolate chip cookies.
Yeah, well, you can take a Cinnabon.
At realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, thanks for joining the show this morning. We're working through this Moody's debt downgrade issue, kind of going, and look, just so you're aware, I have a whole article. It's a very long article this morning, unfortunately, but there's a whole article posted at realinvestmentadvice.com. It's also on my Substack account at Lance Roberts. I've also posted a link on Twitter at Lance Roberts, so you can get it, but it's called the Moody's Debt Downgrade. So I've written a whole descriptive article about everything we're going through here. It's published. It's out this morning for you, so you can kind of work through some of this, because there's so many misnomers, and headlines are being put out simply to grab clicks and views and to feed into your fears, and most of it is complete nonsense from people that do not understand the monetary plumbing of how our government works, or how the system works. More importantly, is that, if you don't understand that, making all these claims about, the end of the world as we know it because of the debt is laughable. But and I saw an interesting piece this morning. It's a guy published out a piece this morning showing the trajectory of our debt to GDP, just, kind of the straight 45-degree angle up. And by 2050, we'll be at 120% of debt to GDP. Japan's at 240. They're still here, right? They're not bankrupt. But yet we're worried about 120% of debt to GDP, and it's the end of the world as we know it, right? I wish we could use copyrighted music, because that'd become our new theme song. But anyway, I've got an article out this morning. So again, this is not the first time that I'm gonna have to go. This is pretty chart heavy, so we're going to move pretty quick this morning. But again, if you go to the website, Substack, X, links to the article, so you can take your time. I've got lots of context around everything I'm writing, so you'll have it there. But this, again, this isn't the first time that we've downgraded debt. In 2011, August of 2011, we were in the middle of the debt ceiling debate under the Obama administration, and we're trying to figure out how to lift the debt ceiling and issue more debt. There was this big standoff in government. And at that time, Standard & Poor's, came out and downgraded the debt. This is what they said. I want you to pay attention to what they said then. Now, this is 2011. This is 15 years ago. Okay? 15 years ago, this is what S&P said. In July, S&P placed the United States rating on credit watch with negative implications as the debt ceiling debate devolved into partisan bickering. To avoid a downgrade, S&P said the United States needed to raise the debt ceiling and develop a credible plan to tackle the nation's long-term debt. In its report on Friday, this is August the 5th, S&P ruled that the U.S. fell short. The downgrade reflects our opinion that the plan that Congress and administration recently agreed to falls short of what, in our view, would be necessary to stabilize the government's medium-term debt dynamics. So they downgraded it. This is August the 5th. Now, here is a chart of the S&P 2010, 11, and 12. And what you'll see is that the markets had a very, very big rally. From September of 2010, the markets had this very, very big rally. And, of course, that was following the QE2. By Ben Bernanke at the time, back in August, September, markets had sold off because QE1 had ended in May, June. Markets sold off. They came in with QE2, so we had this big rally in the market. So markets were very overbought, very extended, needed some catalyst for a pullback. Plus, this is summer, right? So QE2 was ending. So we've now run out of QE. We're in the middle of summer. We have this debt downgrade, and the market sells off. Now, in September of that year, Federal Reserve steps in and says, okay, we're going to do Operation Twist. And we start doing Operation Twist on that. And the market started recovering and going off. So the market did respond negatively to that announcement because the markets were extremely overbought. Again, as we said before, when markets are moving higher, you get a lot of momentum in the markets and nobody wants to sell because they're worried about the markets going higher. They don't want to miss out. So that was a good reason for traders to come in and take a profit. So the markets did react negatively initially to that debt downgrade, and then it was over and markets took off and started rallying. Of course, we then had the rally for the next 10 years in the markets following that. But here's what bonds did. So same type of chart, same 3-year period. And initially, when you had the debt ceiling downgrade, yields spiked momentarily and then declined further. So again, this whole concern is like yields are going to go to 6, 7, 8% because this debt downgrade didn't happen in 2011. Then today's different than then, right? But again, we have to look back at history. How did bond markets react? Because again, if the debt downgrade doesn't matter to the buyers of treasuries, then why are yields going to rise? Right? Something about. Now, so you remember, interestingly enough, that what S&P said is that there was no credible plan for deficit debt reductions. Okay. August 1st, 2023. So remember, August 5th, 2011 is the S&P downgrade. Almost exactly 12 years later, August the 1st of 2023, Fitch downgrades the U.S. debt by one notch, outlook stable, those type of things. The rating downgrade of the United States reflects expected fiscal deterioration over the last 3 years, a high and growing general government debt burden, and the erosion of governance relative to AA, AAA rated peers over the last 2 decades that has manifested in repeated debt limit standoffs and last-minute resolutions. Sounds very familiar, right, to what we heard in 2011. At that time, Janet Yellen came out and she says that she disagreed with Fitch's downgrade in a statement to The Guardian. She said it was arbitrary and based on outdated data. And she was right. Jamie Dimon, who is the CEO of then and now of JP Morgan, said the most salient statement regarding the Fitch downgrade at the time. And this really applied to the S&P downgrade, applies to the Moody's downgrade today. He said this: it doesn't really matter that much because it's the market, not rating agencies, that determine borrowing cost. Still, it's ridiculous that other countries have higher credit ratings than the U.S. when they depend on the stability created by the U.S. and its military. That is a key statement. In other words, a lot of these other countries that may have a relatively higher credit rating, if it wasn't for our military and our fiscal demand on their economy, our what we provide them, they would not be in the situation that they're in. They are heavily dependent on the U.S. To have them be AAA rated and not America is kind of ridiculous. It's still the most prosperous nation on the planet, and it's the most secure nation in the world. He's right on all counts. Same thing today. But let's go back and let's look again. How did the market respond? Let's take a look at the S&P. This is 2023. Markets are so we have this very strong rally that starts in October 2022. Markets are very overbought going into the summer of 2023. Now, I will remind you that as we headed into the summer of 2023, we had a couple of things going on. We'd had the Silicon Valley blow up back in March. And we were having this massive AI chase. And you'll remember that as we were heading into the summer of 2023, it was all about AI. And then all of a sudden, it was all these questions evolved around the sustainability of AI. Is AI going to be prosperous? Is there going to be, any real outlook for this? And the market declined by about 10% that summer, peak to trough. A 10% decline, peak to trough. After that massive rally from October 2022, again, the market just needed a reason to sell off, and that was as good of reason as any. So in both cases, when we had debt downgrades, markets did temporarily, bring that chart back up for me real quick, Brent. Markets did temporarily respond negatively, but though in both cases, that decline in the markets was a buying opportunity for equities. Why? Because the debt downgrade doesn't matter. All that matters for the markets is forward earnings and forward earnings expectations, and doesn't matter what the debt is rated. But let's talk about the debt. This is Treasury bonds. Same time frame. We had the debt downgrade and basically yields spiked momentarily and then went down. Again, because what drives yields is not the rating. It is perceived inflation, it is economics, and it is term premium. And if you take a look at where we are right now with inflation at 2.3%, you add that to 2%, 2.4%, 2.3%, sorry. Economic growth, that's 4.6. Where's the yield trading currently? 4.5. Exactly where it should be. In both cases, both previous downgrades, and we're going to come back and we're going to look at, where we are currently after the break. But in both previous cases, the debt downgrade, it only really mattered to stocks and bonds for a moment. And actually, in both cases, the markets were exceedingly overbought and needed a correction, and that was simply just part of the catalyst for the correction. But in both cases, the dire predictions of the end of the world did not come true. We'll come back and wrap this up on the other side of the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How confident are you in your retirement income strategy? Join RIA for a powerful in-person workshop designed to help you build a sustainable, tax-efficient income plan for retirement. Richard Rosso and Danny Ratliff host the RIA Retirement Income Empowerment Workshop, Saturday, June 14th at the Hyatt Centric in the Woodlands. Learn how to protect your nest egg, optimize Social Security, reduce taxes, and create income that lasts. Register now for the RIA Retirement Income Empowerment Workshop with Ratliff and Rosso at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, just want to wrap this up. These debt downgrades, again. So, I want to take this back to kind of where we started our conversation a little bit, because this is really so very important. All these headlines you're going to see about, oh, this is, you know, the demise of the economy and all this stuff. And look, I'm gonna show you a chart here, and I'm not making a comment on gold. Okay. But, well, I'm sort of making a comment on gold, but I want to show you this chart. This chart is the performance of the S&P and the performance of gold since 2011, August the 5th of 2011, when we did the first downgrade. So the point of this chart is that if the debt downgrade was the end of the world as we know it, you wouldn't have this performance gap between gold and stocks, right? Stocks would not have performed because the economy would be in collapse and all this other stuff. So all this narrative, that's good, Brent, all this narrative about the demise of the U.S. because of the debt, the demise of the U.S. because of the deficit, you know, the loss of reserve currency because of, you know, all these things. I'm not saying that having debts and deficits is a good thing, but we have to keep this somewhat in perspective. Here's a chart of Japan. There is a consequence for debts and deficits, and that is slow economic growth, low inflation, and other economic prosperity issues, which we have, and that's a function of the debt. But Japan's debt to GDP is you know, based on this basis now, if you add in all their other liabilities, which this is just the government debt, but they're more like 250%, but even at 220% of debt to GDP, they're far way ahead of the U.S. Their economic growth runs at about 1% to 2% annually. Their interest rate on their 10-year bond is 0.92. So the point is that the more debts and deficits you have, you can't sustain higher rates because you can't sustain economic growth. So rates and inflation fall over time because of debts and deficits. Debts and deficits are not a good thing. But in our economy, where we are today, again, we can't reverse out of this into a budget surplus overnight. You'll be in a depression. You cannot extract that much capital out of the economy. Markets are overbought. You're going to have a pullback in stocks most likely, depending on how big it is. Don't know. But it was about 5% in 2011. It was 10% in 2023. We just had a 20% correction. Maybe a bulk of the correction is front-loaded. So we get a 3-4% correction off this announcement. Just get some buyers out of the markets, get some of that momentum trade off the table, and then markets can start to do whatever they're going to do again. But as I want to go back to our original point. The process of creating money in the private sector is very important. So because the government is issuing debt, that is a net positive to the U.S. economy. We talked about how it winds up on the balance sheets of households and banks. The argument is U.S. debt levels are too high. U.S. debt levels have been too high for 40 years, 45 years. We've been running a deficit since 1980. What's been the consequence of running a deficit since 1980? Slower rates of economic growth, declining inflation, lower interest rates. Just like Japan. So if you want to look at a microcosm of where we're going to wind up, look at Japan. I'm going to write a whole article on this, by the way, so just sit tight. But we're on the same path as Japan. It's not a good path, right? But it's not the devastating path that people tell you about to get headlines, clicks, and views. For every US dollar that the U.S. pays on interest on the debt, there's an investor willing to make dollars on risk-free interest rates. And this is a critical understanding. When the U.S. pays interest, somebody is receiving them. If you went out and did T-bill and chill over the last couple of years, you're receiving interest payments from the government. This is what I was talking about, how it winds up on your balance sheet. You own the debt. The government is paying you dollars. You're benefiting from that risk-free status of the debt. The reason I keep repeating that is that's the most critical factor to understanding how the government works and the bond market works. The only real limitation of deficit spending is really scarcity of resources. There are some budget constraints that the U.S. government is dealing with right now. And this is why we keep doing continuing resolutions. Somebody in the comment a minute ago, by the way, hit the like button for us. We got 1,000 people hanging out this morning listening to the chat. We appreciate you. Give me a like button. But we have not passed a budget since Obama took office in 2008. We've been doing continuing resolutions. And if you really want to slow down the rate of spending increase, because when you do a budget, a continuing resolution that increases spending by 8%, you can do math, rule of 72. If you're increasing your spending by 8% every year, every 9 years, you're doubling your rate of spending, right? So if you really want to control spending, start requiring government to pass a budget. And that was a very good statement in the chat this morning. But the real question is, how does this downgrade affect investors? And the key point is that a AA plus or a AAA rating does not change the most widely used form of collateral in the world, which is the U.S. Treasury. You have the U.S. Treasury market is the deepest in terms of liquidity. It has a very deep repo market. It has very solid democratic foundations, the rule of law. We've talked about the military, all those type of things. Those are very critical aspects to the sovereignty and stability of the U.S. government, and more importantly, their debt. It doesn't, Fitch, Moody's, S&P, These are paid ratings. If they were truly concerned about the rating of the U.S. government, they would have downgraded this rating 20 years ago, 30 years ago. Doing it now has little meaning. At the end of the day, commercial banks, huge buyers of treasuries, institutions, huge buyers of treasuries, pension funds, municipalities, banks, individuals, foreign institutions, foreign pensions, anybody that needs to store collateral for any reason. And look, a vast majority of money market funds, pension funds, hedge funds, they are required by their investment policies to own U.S. Treasuries. They have to own risk-free assets. The only choice for that is U.S. Treasuries. That is not going to change because of the rating. I forgot insurance companies. Huge buyers of U.S. Treasuries. But Treasuries are the most widely used collateral in repo transactions. And that is an important driver for the markets. So again, just, if we go back and so are there problems? Yes, we have problems. One of the things that is going to be a huge issue for treasuries, and I got this chart for you, Brent, is we have a massive short position. So people have been asking, well, why do treasury yields keep going up here? Because you have massive short players right now in the markets that are shorting bonds to make money. It is simply a transaction for them. They don't care about the rating. They're not making a statement about U.S. sovereignty. They are simply going, I have the ability to make money here by shorting treasuries. We are running the largest short position in U.S. history. In fact, our daily market commentary today, if you go to the website and download our daily market commentary, we also note that there is a record short position on TLT right now as well. Simply a function, these traders can manage the markets. They can move markets by shorting heavily on leverage and move interest rates to make money. When interest rates fall, that short position has to be covered. And that's going to wind up, when we wind up in the next recession, whatever it is, that causes a reversal in rates, that massive short position, when it's covered, is going to cause rates to plummet. That's just a function of market dynamics. So Scott Besson over the weekend, echoing what Janet Yellen said, think Moody's is a lagging indicator. He's right. But the real issue is that as we look at the markets and look at history of how markets have traded on these downgradeds, stocks typically take an initial hit. So we talked about before, great opportunity. Take some profits, rebalance risk, reduce your exposure a little bit. Look for this pullback to occur, which we need to have a better buying opportunity. But at the end of the day, does the Moody's downgrade matter? The answer is no. Doesn't matter one iota. It's not even worth paying attention to. Is it going to affect the market short term? Yes. And we can all point to the Moody's downgrade. That's the reason why. But it's not going to matter. Not in the long run. Hope this is helpful. The article is on the website right now, realinvestmentadvice.com. It's on our Substack account. If you're not following us there, follow me at Lance Roberts on Substack. Also on X is posted there as well for you. Read the whole article. It's a bit long. Lots of detail in it, but it's all there for you. realinvestmentadvice.com. Have a great day. We'll see you back here tomorrow.